Hello everyone, and welcome to MichaelCryptoCash. Today, we'll explore a crucial topic for understanding the dynamics of the modern economy: interest rates. This concept is fundamental not only for those involved in investments and personal finance, but also for anyone who wants a clearer view of how the financial world operates and how economic decisions affect our daily lives. We'll delve into what interest rates are, how they are determined, and their impact on various sectors of the economy. What is an interest rate? An interest rate represents the cost of borrowing money or the return earned on an investment. In other words, it is the price paid to access capital today rather than in the future. Interest rates are a key measure reflecting the value of money over time and influence a wide range of economic and financial decisions. Let's look at the different types of interest rates and how they differ from each other. 1. Nominal interest rate. The nominal interest rate is the stated rate on a loan or investment without considering inflation. For example, if a loan has a nominal rate of 5%, this is the interest that will be paid on the loan or earned on the investment. However, this rate does not account for how inflation might erode the purchasing power of money. 2. Real interest rate. The real interest rate is the nominal rate adjusted for inflation. It provides a more accurate measure of the actual cost of money in terms of purchasing power. For example, if the nominal rate is 5% and inflation is 2%, the real rate is 3%. This rate is particularly useful for evaluating the real return on investments and the true cost of loans. 3. Simple interest rate. The simple interest rate is calculated only on the initial principal, without accounting for accumulated interest. This type of calculation is often used for short-term loans and straightforward calculations. 4. Compound interest rate. The compound interest rate is calculated on the initial principal plus accumulated interest. This means that interest is added to the principal, and subsequently, the accumulated interest also earns interest. This type of rate is common for long-term investments and savings. How are interest rates determined? Interest rates are not fixed and are influenced by a variety of economic and political factors. Let's examine the main forces that determine interest rates. 1. Central banks, such as the Federal Reserve in the United States or the European Central Bank, ECB in Europe, play a crucial role in determining interest rates through their monetary policy. These institutions are responsible for controlling the money supply and influencing overall economic conditions. They can raise or lower interest rates to achieve specific economic goals, such as controlling inflation or stimulating economic growth. When central banks raise interest rates, the cost of borrowing increases, making loans more expensive and slowing down spending and investment. This can help control inflation. Conversely, when they lower rates, the cost of borrowing decreases, stimulating spending and investment, and ultimately supporting economic growth. 2. Credit market. The credit market, where loans and deposits are exchanged, has a significant impact on interest rates. In a market where the demand for loans is high, interest rates tend to rise because lenders can charge a higher return for the capital they provide. Conversely, when loan demand is low, interest rates tend to decrease to attract borrowers. Economic conditions, banking policies, and the expectations of consumers and businesses affect the demand and supply of credit, and thus interest rates. 3. Inflation. Inflation represents the general increase in the prices of goods and services in an economy. Inflation expectations have a direct impact on interest rates. If lenders expect prices to rise, they will require higher interest rates to compensate for the loss of purchasing power of money. Conversely, if inflation is low or declining, interest rates may be lower. Central banks closely monitor inflation and adjust interest rates to maintain price stability and ensure sustainable economic growth. Impact of interest rates on the economy. Interest rates profoundly affect various aspects of the economy. Let's explore how these rates impact economic growth, inflation, the real estate market, investments, and currency markets. 1. Economic growth. Interest rates play a crucial role in economic growth. When interest rates are low, the cost of borrowing decreases, encouraging businesses to invest in new projects and consumers to spend more. This increase in spending and investment stimulates economic growth and can lead to higher employment. Conversely, high interest rates can slow down the economy. Businesses may postpone investments, and consumers might cut back on spending, potentially leading to slower economic growth and even a possible recession. 2. Inflation. The relationship between interest rates and inflation is complex and vital. Central banks use interest rates as a tool to control inflation. When inflation is high, central banks may raise interest rates to reduce aggregate demand and cool down the economy. This helps keep inflation under control. However, increasing interest rates can have side effects, such as slowing economic growth and raising borrowing costs for businesses and consumers. Therefore, central banks must carefully balance rates to avoid excessive inflation or economic stagnation. 3. Real estate market. The real estate market is strongly influenced by interest rates, particularly mortgage rates. When interest rates are low, mortgages become more affordable, which can increase the demand for homes and drive up real estate prices. This can stimulate the construction of new homes and boost the economy. On the other hand, high interest rates can make mortgages more expensive, reducing the demand for homes and leading to stagnation or a decline in real estate prices. This can have negative effects on the housing market and the broader economy. 4. Investments. Investments, both in stocks and bonds, are highly sensitive to interest rates. When interest rates are low, companies can borrow at lower costs, which can increase profits and drive up stock prices. Investors may seek higher returns in stocks or other investments compared to the relatively low returns from bonds. Conversely, high interest rates can reduce corporate profitability as financing costs increase and may lead to a decrease in stock prices. Investors might prefer bonds and other fixed income instruments that offer more competitive returns compared to stocks in a high interest rate environment. 5. Currency markets. Interest rates also have a significant impact on currency markets. A country with higher interest rates can attract foreign investors looking for higher returns, increasing demand for that country's currency and strengthening it. This can make the country's exports more expensive and less competitive internationally. Conversely, low interest rates can reduce the attractiveness of a country's currency to foreign investors, leading to a depreciation of the currency. A weaker currency can stimulate exports by making a country's goods and services more competitive in international markets. Conclusion. Interest rates are a central element in managing the economy and have an impact on many aspects of economic life. They are influenced by macroeconomic forces such as central bank policies, credit market dynamics, and inflation expectations. Changes in interest rates can have far-reaching effects, from economic growth to the real estate market, from financial investments to currency strength. Understanding how interest rates work and how they interact with other economic elements is essential for anyone navigating the world of finance and economics. We hope this overview has provided a clear and useful insight into interest rates and their fundamental role in the modern economy. Thank you for joining us on MichaelCryptoCash, and see you next time